Hello, I'm David Darst. Welcome. They say the month of February is named after the Roman word februum, which means cleansing or purification. The Romans named this month because it was a month of rains and washing away, and there's certainly been a fair amount of cleansing and purification in this month. So far, the Standard & Poor's on a year-to-date basis is down about 8% for the year. During the month, as you know, it sank. It was actually down into correction mode. It was down over 10% versus its record, which was set, as you know, on January the 3rd of this year, of 4796.56. NASDAQ has suffered even more because many of these stocks were very highly valued. NASDAQ so far is down about 14% for the year, and it's down about 16% from its November all-time record high. Volatility got up to close at the end of the month at 30.32. As you know, the long-term average is about 21 for the volatility index, the CBOE volatility index, which measures, and it's one measure in what they call the fear index. And when it's high, it indicates a fair amount of anxiety, people buying put options, selling call options, buying and selling all kinds of options because of wanting to hedge their positions. It got up as high as 33, which is often, from a contrarian standpoint, it's a time actually to start nibbling, start buying. In the Treasury market, the 2-year Treasury towards the close of the month was yielding 1.54%, and the 10-year 1.96%. Now, you know we've been talking about this margin, the interest rate spread between the 2-year Treasury and the 10-year Treasury. 1.96 minus 1.54 is 42 basis points. It started out the month of February at 1.18% for the 2-year. So it went up 36 basis points from 1.18 to 1.54. The 10-year went from 181 to 196. So it did not go up as much. It went up only 15 basis points. Why? Many people think that if the Federal Reserve is going to be tightening monetary conditions, that at the back end, we might see the economy slowing and people want to buy bonds to protect their portfolios, perhaps as a hedge. Therefore, interest rates not rising as much on the intermediate and long end of the Treasury curve. At the beginning of February, that margin was 63 basis points, and at the end of February, it was 42 basis points. So it contracted by 21 basis points. Another winner for the month of February was oil. Brent got up touching $100 in the high 90s. West Texas Intermediate is up 23.3% for the year, $93 as of the end of February. Gold, the cryptocurrency space, had a difficult month, and investors basically began to look back to gold. Gold is up 5.3% for the year to a price above $1,900 per troy ounce, $1,925. Value stocks and growth stocks, we'll come back to this in a moment, but value stocks on a year-to-date basis are down about 6%, and growth stocks are down about 14%. Make no mistake, the Federal Reserve has had an ongoing debate throughout the month of February, an ongoing debate it's been publicly released in these speeches by Fed governors, voting members of the Fed, and permanent members of the Federal Reserve Board of Governors, voting presidents of the regional Fed banks. Basically, a number of them have been calling for, in March 15th, 16th, will be the next Fed meeting, the Federal Open Market Committee meeting. Many people have been calling for, I would say, a handful of people have been calling for interest rate increases of 50 basis points in the meeting that's going to be on March 15th, 16th. And also an acceleration of the pace of interest rate increases. You've got some banks, some very big banks are calling for, they're expecting 7 interest rate increases of 25 basis points each this year. So that's caused some people to think about monetary policy tightening. And another form of monetary policy tightening is what they call quantitative tightening, where the Fed is beginning to think about and discuss openly reducing their huge portfolio of $9 trillion worth of mortgage-backed securities and Treasury securities. Then, why is the Fed feeling this way? They're what they call behind the curve. They're late in terms of beginning to try to slow down inflation. I think inflation caught many people by surprise. It caught people by surprise due to strong demand. And of course, you had this constraint of the supply due to transportation, logistics, bottlenecks, okay? So the pressure is on the Fed to respond and to try to regain control over the narrative. Right now, the markets feel the Fed maybe has not been paying enough attention and has not been moving with enough speed and alacrity to bring inflation under control. Finally, we come to the developments of late February, February 21st, 22nd, 23rd, 24th, and you had there the incursion into Ukraine, to the eastern provinces of Ukraine, and then extended into the country overall, with armed conflict breaking out, with aerial bombardments, with shelling, with gunfire, with loss of life, okay? And there you had sanctions imposed by the United States, certain sanctions on technology transfer, on individuals, and of course on parts of the financial system of Russia. The Russian stock market, basically in one day, it fell 31 or 32%. And so far this year, the Russian stock market is down 53%, and the Russian ruble versus the dollar is down another 11%. So it has cost the capital markets of Russia what the market reaction has been. Where do we come out on this? I think markets have not decided to go into a full panic or risk-off mode. There has been some buying of treasuries, which has kept the yields from rising. It's actually pushed them down a little bit. There's been obviously the buying of gold, okay, and looking for companies that can withstand and have no exposure. But really the three questions that we're left with right now is, what is the length? What is the length of this conflict? What is the severity of the conflict? And what is the extent of the conflict? Is it going to just be within the country? Is it going to involve its neighbors? For the market to really, I think, get very panicky, you would have to see perhaps NATO get involved. Right now, everyone says NATO is not going to get involved. There's not going to be anything. The final two questions is, what is the short-term outcome? Not only for oil, Russia produces 10 million barrels a day, as you know. What is the outcome for oil? What is the outcome for aluminum? What is the outcome for wheat? Russia and Ukraine are 33% of the world's wheat exports. Egypt is a huge importer of wheat, for example, from Russia and from Ukraine. What is this going to mean as far as trade, as far as commercial activity, much less financial activity? The answers to this are not known as we begin to enter March. We're left with this tripartite strategy that we've been talking about. 1/3 value. This is your energy. This is your banks. Okay. This is goods quality consumer companies. 1/3 growth. And that's some of these great companies that have tremendous balance sheets, that have tremendous market positions, that have tremendous returns on equity. 1/3 growth, and then 1/3 defensive. And these defensive stocks are things like healthcare and consumer staples. These are consumer products. These are things that have much lower exposure to economic activity. With that, we wish all of you a great start to the month of March, and we look forward to being back with you very soon.